All right, good evening, greetings. This is the first of maybe a couple videos going over the practice questions that have already been posted to the supplemental readings for Chapter 7, Module 3. I'm going to go through and explain what these are all about. First of all, self-assessment question 2 here. Which of the following costs should not be taken into consideration when making a decision? Again, this chapter, a lot of it's based on the prior chapters that you've already done. So now you're looking for what do you not need to worry about when making a decision. And we did talk about this. It's the sunk costs, as they're described here. They already occurred. We're trying to make a decision based on a new day. Let's call it today, which is, let's say, today in time. The costs that are sunk costs happened in the past. Our decision process is now on decisions A or B or C, whatever, going forward from today. And so then the result is that anything that was incurred in the past, we can't do anything about it. We can't get those dollars back. Our decision on what to do going forward is only based on what the new decisions will bring in terms of dollars and cents. Some of that gets illustrated in some of the problems that we go through. Let's go to the next question. All right, so this is a multiple choice question 28, which the following is not quite often not incremental, and the answer here is based on, again, prior chapters. Well, this is an incremental cost, goes up or down based on production. Same thing here. These direct costs are those costs based on actual production, so they're variable. That's the key with those. They're variable. Those are always incremental, variable costs. So here's the word, and so it obviously is that, and this leaves this as the only answer. And the issue that is nice to see is, notice the problem says quite often. So that way you know that you have learned that sometimes even fixed costs, if they're step fixed costs, things like that, they can change based on amount of production or volume, and so they have a variableness to them, but generally, quite often, they're not incremental. They don't go up or down based on production. Okie dokie, so let's look at this one now. Which of the following is a cost that does not differ between decisions? And actually that word should be written or pronounced differ, not defer, differ. Which of the following is a cost that does not differ between decisions? And this is a more challenging type question, but let's see what you've got. You got opportunity costs that can change based on decisions. In fact, that's the whole that may be arguably the whole reason for getting involved in looking at numbers for decision process. What is the opportunity cost for choosing A? What is the opportunity cost for choosing B? That's what we're really looking at. Controllable costs, of course, can differ between decisions. What can you control, what can you not? Incremental costs obviously are based on being different between decisions, because that's the whole issue that we're looking for. When you look at these choices of A, B, or C to decide which ones to do, the issue that you're looking at is not only the opportunity costs, but primarily what are the incremental costs between the two decisions, and what changes in the fixed costs. So the one cost that doesn't differ between the decisions is the unavoidable cost, meaning it's going to be there regardless, and in the case of your two choices or more that you're looking at. And I think another word to use for unavoidable costs would be fixed overhead. That's really just another phrase and another easy way to use the prior material that you've learned about and to think of what are unavoidable costs. Fixed overhead. Yeah, the primary example is you're in a building, you're manufacturing A, and now you want to say about, well, let's look at manufacturing B or C instead of A. The one cost that's unavoidable in either of the two decisions to go to B or C would be the fixed overhead. Hence it's an unavoidable cost. All right, which of the following is a cost that was incurred in the past that will never be incremental? And based on how we started this recording, this should be an easy answer to come up with. And the fact that we already spoke about it in the first question, and the key is what was in the past. It's never incremental and never even considered at this point as well. So that would be sunk costs. They happened in the past, they're done, nothing we can do about it. A product line should be dropped when? So this is sort of I wouldn't say a trick question, but a overly easy question if you look at it. And let's take a look. If something has a positive contribution margin, well, it's helping pay for overhead. It's helping get something to the bottom line, because contribution margin means it's got some kind of profitability to it. Maybe the fixed costs eat up the profit margin, but that's not something that's not something that should be charged against the particular product line. Again, the product line is selling and it's yielding, let's say, 15 cents profit before deducting fixed overhead. Well, fixed overhead is the unavoidable costs. So we can't change that. Maybe there's some other issue where we might say, well, we shouldn't continue this product line, but it's not an automatic if it's contributing a positive contribution margin. And remember, contribution margin is sales minus the cost of goods sold. That's what the contribution margin means. Gross profit is the other terminology for it. What if it has unavoidable fixed costs? Well, they're unavoidable. So if they're unavoidable, they're going to be unavoidable for the other product lines as well. So that's a fixed overhead item. Nothing we can do about that. That doesn't enter into our decision process. However, let's say that this particular number here, this 15 cents, is nice. It's a profit, but you know what? We've got some other choices. We've got an A and a B, and those choices are going to look like contribution margins of 25 cents or 35 cents, and they'll cover the overhead better. They'll cover all the fixed unavoidable costs better than the 15 cents. There's no doubt about that. So when they do, there'll be a positive change in income if we get rid of this product and go to A or B. That's the answer. So the product line should be dropped if there'll be a positive change when going to an alternative choice, and this is an example of why that could be, because the contribution margins in the other choices are just better. All right, so I hope you see that. And if not seeing it quite clearly, you're going to see it in some of the examples we're going to come across, mathematically numeric questions that we're going to have. Let's take a look at this guy. When the department or product line is dropped, the common fixed costs that had been allocated to that department, the common fixed costs, read into there, the unavoidable costs that have been allocated to that department are going to be, well, they're not sunk costs, because we're talking about what are they going to be now. They're not eliminated. They're unavoidable. They're not going to be variable. They're always once fixed, always fixed. Obviously, there's that there's those mixed costs, and there's the step. But we're speaking in general terms right now. And the way to look at it is, again, common fixed costs are unavoidable. And thus, if we drop product A, where we had been allocating a certain amount of unavoidable or fixed cost, we drop that product, oops, gone. So now we have to look to other products that we're doing, and those costs are going to have to be allocated to those other products. That's the answer. Okay, this is a numerical problem. Let's see if we can tackle this, and then we'll stop here after we do this. Let's take a look. This will illustrate some of the concepts we've just learned. You hopefully have read through this, so I'm not going to go through every detail in slow motion. Basically, we're looking at part B13 has been produced at a certain cost. and they give us all those costs. Now they're thinking of, instead of manufacturing that part, they want to buy it from an outsider. This is a typical decision, and if they buy it from an outsider, we're told that 50% of the admin costs would be avoided. So let's see what that means. In terms of, if we do not buy this product, if we do not produce it ourselves and we buy it, let's see what we're going to save. Well, per unit, we're going to save $12 because that's direct material. We're going to save $9 labor because that's direct, so that's incremental. The factory rent, so that's a question. What happens to the factory rent? So let's see more about what the problem tells us. It says Part B13. See where it says Part B13 there? Our manufacturer, or rather it says all of the company's items. So let's read this all together. All of the company's items, all of the company's items, including Part B13, are what? Are manufactured in the same rented production facility. So that tells you that even if we drop producing Part B13, we're still going to have the rent because we have that for the other products. So that's an unavoidable cost, and we'll continue to have that rent. So the rent will be not dropped. It'll be somewhere else. It'll be allocated, say, over here, but it'll still be a cost that we're incurring. The administrative costs, we're already told that 50% of it will be saved and avoided, meaning it won't be unavoidable. So of that, $5 savings there. And the general factory overhead is back to the same concept of the factory rent, unavoidable. So we'll put that $7 over here. So how does this all add up now? Let's see. If we do not produce this part, let's see what we will save. We'll save these expenses, which we've outlined here. These are our variable costs, and the part of the administrative costs that we're going to save, that comes out to $26 per unit that we're going to not incur. So we'll not have that. Remember, these costs over here, we're going to still have those. So we don't include that in our calculation because they're going to continue. They'll be allocated to other products, but they're not, just because we don't produce Part B13 doesn't mean we're saving those dollars. We're only saving the incremental or variable costs that will be saved, the variable plus whatever of the unavoidable costs that can be avoided. Let me say that again. And really, what I'm going to do is make a little space here. The unavoidable cost that we can save, is the problem tells us, is half the admin. So you otherwise might have thought that that was unavoidable, but they say, oh, you know what? You can avoid half of it. And so that's why it uses the word. Look what it uses. It uses the word would be avoided to show that that's fixed overhead can be saved. Okay, so now that means what we save is $26 per unit. Sorry about that. $26 per unit. What's it going to cost us to buy it from an outside source? $31. Ooh, this is not a positive result. Well, these problems aren't going to always end up with positive result. So what the answer is the cost for the part will increase by $5 per unit, and thus the decision is going to be what? And that's going to be continue to manufacture Part B13. All right, we're going to stop here, and we'll pick it up in the next video.